Hi friends, welcome to my 10 Cents. Warren Buffett has said, if you have an IQ more than 120 or 130, you can afford to give that IQ away to someone else. You don't need extra intelligence or extraordinary intelligence to be a great investor. When you talk about investing and equity investing, the key is simplicity. It may be contrary to what you're thinking, especially people who have just entered the world of investment, where if you switch on the TV, you will find all sorts of fancy charts, all sorts of analysis, rattling numbers, ratios, and it always looks like an action thriller movie. But the reality is, if you ask any seasoned investor to make good returns on a long-term basis, the key is simplicity. Also, I have to quote Paul Samuelson. He has said that investing is like watching a paint go dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. The second most important principle, patience. So, investing in markets is all about simplicity and patience, and for most investors, the simplest way to invest is equity mutual funds. Not entering their markets directly, not chasing in the next hot tip or the next hot share, but to just focus on good performing mutual funds which have a history of outperforming the markets for a long time. So equity mutual funds is the key for most of us who are looking for sustained wealth creation. And in this video, we will talk about the basics of equity mutual fund and how to choose a good equity mutual fund. Let's first understand what equity mutual funds are. If you're already aware about equity mutual funds, you can skip ahead in the video. Equity mutual funds aggregate money from investors like you and me who could be investing as little as 500 rupees a month. They accumulate a pool of these funds and then they invest in share market on your behalf. There is a professional team, there is a fund manager who has a lot of analysts who give day to day, who track the markets day to day, and they invest the money in the shares. And your return in the fund goes up when the shares that the fund manager has invested on your behalf performs very well. When the companies which you have invested in does very well, when the profits of the companies do very well, at that point, the share value of the shares that you hold also will increase. And when the value of the shares increase, the value of your investment in the mutual fund will increase. Here, the money is pooled and put into one pool of capital, one fund, and you are issued a unit which shows your shareholding in the fund. It is called NAV, Net Asset Value. We have separately covered the basics of mutual fund in a separate video. You can go through that if you are not familiar with concepts like NAV, how mutual fund works, asset management company, fund manager, etc., etc. But in simple words, your money is pooled by a professional team and they invest money on your behalf in the share market. That is mutual fund. Why do I say mutual fund is a superior form of investing than getting directly into a share market? That is because mutual fund has some advantages. First, in equity mutual fund, you get a professional team. There is a fund manager and the fund manager has a team of analysts who spend all their day tracking the markets, tracking the share, studying them, in understanding the shares in greater detail. This is a lot of hard work. Most of us who have a day job, who have to take care of our job, our career, our family, our children, this is too much of a burden to carry. And the problem is, people often get carried away with the excitement of share market that they often invest on the basis of tips they get from their friends or somebody in the market. Often they don't even have time to study the shares. They just simply go by tips and they may buy for sure based on tips. But after that, they are not tracking the share and they can end up losing a lot of money. I'll give you an example. Reliance Communications in 2006, the share price quoted over 300 rupees. Today, that share price is 3 rupees. So if you had invested in Reliance Communication based on some tip, and after that you got busy with your life, and if you had forgotten all about it, you would have lost over 95-98% of your wealth invested. Whereas in a mutual fund, there is a professional team who has the ability to track these events and invest and enter and exit as required. So that's the first advantage. Second, if you have decided to invest in share market and you have decided to invest in the large capitals or the large companies of share market, let's say your corpus is 10,000 rupees or 1 lakh rupees, it doesn't matter. Your ability to buy a lot of shares of high quality companies is going to be very limited, because with a 10,000 rupee corpus or a 1 lakh rupee corpus, there are only so many shares you can buy. Whereas if you invest in a mutual fund which focuses on large cap investment, with the same 10,000 rupee, you get the ability to buy multiple and many more shares. How? Because the fund manager is not working with only your 10,000. That fund manager gets pooled capital from many investors like you who may be putting 10,000 or 50,000 or 1 lakh, and this corpus will run often into hundreds of crores, which gives him the ability to buy any share irrespective of where the share price is, whether it is 1,000 rupees or 10,000 rupees per share. Whereas when you are operating with a corpus of 10,000 or a 1 lakh, you may often not be able to buy those companies whose share price are very high. So that is the second advantage. First advantage, you get a professional team who will do all the hard work for you. Second advantage, you get to buy a larger number of shares in the process. The third advantage, if you're investing directly in share market, other than the hard work of investing and tracking markets, on an ongoing basis, for you to keep managing a large portfolio often requires a lot of work. You need to figure out when those companies are announcing their results, how are they doing well. The post-purchase decision is also equally or more intensive than the pre-purchase decision. Whereas if you're investing through mutual fund, you only need to focus on the 5 or 10 funds that you invest. You just need to track whether they are going good. You just need to review a portfolio only once or twice in a year, 6 months or in 12 months, and just see how they are doing. Are they on track, or is there a better fund out there? If so, you sell this guy and buy the better fund. You don't need to be connected to the market 24/7. That is a very smart way of investing. It frees up all the time in the world that you need to pursue the things that you are passionate about. So with these 3 advantages, having a professional team who will take the decisions to invest for you, ability to buy as many stocks as you may potentially like in your segment, there is no cap on how many shares you can buy. And 3, after you purchase, the tracking of your portfolio, the planning of your portfolio can be very simple and can be reduced to a bi-yearly activity, just once every year or twice a year. So on these basis, for an investor who is hard pressed for time, who does not have the ability to track markets, equity mutual funds are the best way to create long-term sustainable wealth. Now let's look at what are the different types of equity mutual funds available for investment. As per SEBI, the watchdog for mutual fund investments, the watchdog for the markets, SEBI has prescribed close to 12 categories of equity mutual funds, as you can see in the table. Now, the 12th category may look very complex and difficult, but for a normal investor, he just needs to understand only 3 categories. The rest of the 12 categories are built as a combination of this. First, large cap. Second, mid cap. Third, small cap. In very simple words, large cap funds are those funds which invest predominantly in the shares of very large companies. Examples of a large company can be Infosys, HDFC Bank, State Bank of India, so on and so forth. they invest in the shares of very large companies. If you want the technical definition of what is a large cap company, you can read the description. I've given it there. Large cap funds, in simple words, invest in the shares of large companies. Going by the same language, mid cap companies invest in the shares of medium sized companies, and small cap funds invest in the shares of small sized companies. So, every other combination of the 12 categories shown in the table are all built on the basis of these fundamental building blocks: large, mid, and small cap. Now, before you understand the details of these combinations, it is very important to understand one very fundamental aspect of these three building blocks. If you look at the history of mutual funds globally, history of share market globally, large cap funds are the more safer funds. They will give you lesser returns and they will give you lesser risk. Why? I will tell you shortly. Mid cap and small cap are more riskier and also can give you higher returns or higher loss. The reason why this happens is you need to understand the journey of a company. A company is like a child. When a company is created, it is small. Then they would have some product, or they will do some activities, they will grow their profits. As they continue to grow, a lot of wealth creation happens. A huge amount of wealth creation happens as a company starts to grow. So, in the journey of a company from a small cap to a mid cap to a large cap, the wealth creation potential is tremendous. But not all small cap company is able to become a large cap company. Many of the small cap companies just disappear, or they are just not able to make the conversion. As a result, when you invest in mid cap and small cap, your chances of failure are very high. But so also, the chances of the few successes that you get giving multi-digit and multi-fold returns are also higher, as we've shown in an example. So, if you look at the history in terms of risk and reward, large caps are more stable, mid caps and small caps are more volatile, and also higher profit, higher loss. So, when you build and when you look at the 12 combinations given in the table, it is effectively about building a risk profile and a return profile where you are effectively deciding how comfortable are you with the volatility. If you are an absolutely safe investor who do not like much volatility, and when I say volatility, do not compare volatility with a fixed deposit. Well, all equity mutual fund investments are inherently very risky or very volatile. You cannot compare it with a debt mutual fund or fixed deposit. But within the world of equity mutual funds, large caps are like the safest and the least volatile of the pack. So the 12 categories are there. But in reality, if you want to pick funds out of these 12, you only need to focus on 6. The remaining 6, while some of them have good funds, you can ignore it. It will not affect your portfolio creation. And these 6 funds are large cap, which predominantly invest in large cap companies, flexi cap, which have the ability to invest in large, mid or small as the fund manager may deem fit. He has no restriction, no regulation to necessarily invest in certain category. But if you look at the practice of flexi cap over the last few years, they have also predominantly been focusing on a large cap. But compared to large cap funds, they have been taking slightly higher share of mid and small cap. But they are also very close to large cap. Then you have large and mid. Large and mid typically falls in the center zone, in the center of the transition from the safer large and flexi cap to the riskier mid and small. They have roughly 60-40, 50-50 allocation between large and mid and small. And then you have mid cap, small cap. Okay. These 5 category of funds are fundamentally enough, and this is where your entire focus should be. The rest of the categories can be pushed into the peripheral vision. You can create a portfolio without them. I will also add one more category, which is ELSS, that from a purely tax saving purpose. So if you're looking to save tax every year and you want to make a tax saving investment of up to 1 lakh under Section 80C, then there is a category called equity linked mutual funds, ELSS as we call it. You add that also into the mix. So large, flexi, large and mid, small, and ELSS. Practically this is enough. The other categories that you see of multi-cap, contra, sectoral funds, dividend yield fund, my view is you can comfortably ignore them. Without spending time around these categories, you can still build a good portfolio. So far in the video, we have seen what are equity mutual funds. How do they work? Why are equity mutual funds a better form of investment over stock markets, especially for investors who are looking for a little bit easier way, but without compromising on long-term returns? Okay, we've seen that. And we've seen the different categories of equity mutual funds and which are the categories that one needs to focus on. Now there are two questions left. Question number one. Within these categories of 6 mutual funds, that is large, flexi cap, large and mid and small, how should one allocate one's capital? Do I take 50% large cap, or do I take 75% large cap, or do I take 40% mid cap? How do I do that? And the second question, once I've decided how to allocate funds in these categories, how should I invest, or which fund should I invest? Let's take the first question. If you look at the allocation, there is no science. This 100% depends on your risk appetite. For people who are extremely conservative, 100% large and flexi cap allocation is the way to go. If you are okay with risk, then you can start going down the track. Now this is just English logical way of looking at it. Generally, if you are looking at equity mutual fund investment, and if you're investing money which you do not need for the next 5, 7 and maybe ideally 10 years, then you can easily afford to throw a good measure of mid and small. Because mid and small cap over long horizons, 7 to 10 year horizon if I may say, definitely more than 5 years, have created a lot of wealth creation. But in a shorter duration of less than 5 years, small and mid caps, it's very unpredictable. I'll give a case and example of my own. I had invested in a few small and mid caps in 2017, 2018. 18, 19 and 20 COVID bloodbath, my returns were horrible. Just before COVID, I was sitting with probably a single digit return, less than 10% return on my small and mid cap portfolio. And obviously, I'm not even getting into the losses I've taken on COVID fall, because the small and mid cap portfolio fell by more than 50 or 60% in the COVID. So 17 I invested, 18, 19, 20, and a good part of COVID, it was horrible. But after that, the rally that happened, when Sensex went up from sub 30,000 or 28,000 to 60,000, in that rally, the small and mid caps went so much, they increased so much that my overall return on investment from 2017 onwards went to close to 15% per year. So in 1 year, it covered up for all the loss. Now, if I had invested the money in 17 that I wanted in 19 or 20, it would have been a very bad decision. On the contrary, if you look at large cap, if the money that I had invested in 17 in large cap, they gave me a reasonable return throughout till 20, and even the fall and after that also, my return was well in the range of between 10 to 12% consistent. If you look at historic trends on a 10-year basis, ending 2021, December 2021, if you look at the 10-year return, large caps would have given around 12.5% per year, and your small and mid caps return per year would have been 15% or thereabout. Now, please don't think 12 and 15, the gap is only 3, because that is 3% per year. On a long 10, 15, 20, 30 year investment horizon, that 3% creates a staggering wealth multiplying effect. So it's a lot, the 3% is a lot. But be very clear, what portion of your capital are you allocating? So broadly, that's the principle on deciding how much large cap, how much mid cap, how much small cap. It's largely a function of the duration that you are holding, whether you need the funds in the next 5 years or next 10 years, something like your retirement portfolio. Also, how much loss in a worst case scenario that you can afford. Like Jim Rogers has said, once in a while markets have the tendency of not delivering the worst of the last 5 years, 10 to 15 or a 12-year loss. It can hit on a random basis, it can just hit you with a worst loss not seen in the last 10, 12 years. That markets have the ability to do that. And in such scenario, when a large cap may fall by 20 or 25%, small and mid caps can give losses exceeding 50, 60%. Are you comfortable with that level of volatility? If your stomach will churn, then you have to be a little careful. So deciding how much large and mid and small is essentially about understanding long-term potential of large cap return versus small and mid cap, worst case losses in large cap versus small and mid cap. What duration are you blocking the money for? The longer the duration, the more mid and small cap that can afford to choose. Yes, you can also open a spreadsheet and an Excel and start playing around the different levels where 100% small cap and 100% mid cap, or 100% large cap and 100% small and mid cap being on the two extreme ends, and you start increasing and reducing the proportion and see how much extra is your worst case loss likely to be, and against that extra worst case loss, how much extra return can you get. You can do all these analysis. That is for you to decide where the right levels are. We have posted an article where we have shown a few scenarios of best case, medium case, worst case. We have given a few charts. You can find it on the link that I've given in the description. It's available on the website, My 10 Cent. If you don't want to open a spreadsheet, just want a quick and dirty analysis, you can read our article on the website. So, effectively, this is all about equity mutual funds. Which categories to focus, how to build a portfolio, what returns you might expect on a long-term basis. This is all about it. The last question that is left is which funds to invest in this category. I will not spend too much time on that. There is a detailed, nice 30-40 page report which focuses on the top 5 funds in the 6 category. The best large cap, mid cap, small cap, flexi cap, large and mid, and ELSS category. The top 5 funds that we have identified. It's a nice, decent report. It is available to all subscribers of My 10 Cent on our website. You can log into our website and pull your own free copy of the report. And that will give you a good idea of the 5 funds that we consider are top performing. That may not be the only guide. You can do your own independent diligence, but it can definitely be a good educative material for you to as part of your analysis. So I hope you found this video beneficial. Please do like, please subscribe to our channel. Please do share it with your friends. And if you have any comments, do write to us or put it in the comment box, and we would love to hear your comments and observation. That's all for now. See you in the next video. Bye-bye.